Brad Williams, Frugal Finance, growth stocks, definition, examples, and comparisons with value stocks. What is a growth stock? A growth stock represents a share in a company expected to outperform the broader market in terms of revenues and earnings growth. These stocks are typically seen as risky investments, but they offer the potential for significant returns. Companies behind growth stocks often reinvest their profits into expansion or innovation rather than paying dividends. This strategy is designed to accelerate growth and increase the value of the company, which can lead to higher share prices in the future. Investors buy growth stocks hoping to sell them at a profit once the company's value increases. Key characteristics of growth stocks. Growth stocks are known for certain traits. High price-to-earning ratios. These companies often have elevated price-earning ratios because investors are willing to pay a premium based on the future growth potential. Reinvestment of earnings. Rather than distributing dividends, growth companies tend to reinvest their profits back into their operations to fund new projects, products, or technology. Potential for capital gains. Investors typically benefit from growth stocks through capital appreciation rather than dividend income. However, the risk is that if the expected growth does not materialize, the stock price can significantly drop. Growth stocks are often found in fast-evolving sectors such as technology, biotech, and renewable energy. These industries offer new opportunities and are often home to smaller or mid-sized companies, though large corporations can also qualify if they maintain high growth rates. Growth stock versus value stock. Growth stocks differ from value stocks, which are undervalued by the market. While growth stocks are anticipated to grow rapidly, value stocks are typically seen as undervalued and may provide returns when the market corrects its valuations. Growth stocks often come with high price-earnings ratios, while value stocks generally have lower price-earnings ratios. Moreover, value stocks are likely to pay dividends, providing steady income for investors. Value stock characteristics. Undervalued by the market, these stocks are considered to be priced below their actual worth. Dividend payment. Value stocks often provide dividends, offering a reliable income stream for investors. Stronger fundamentals. Value stocks usually have solid balance sheets, lower price-earning ratios, and are less volatile than growth stocks. Some investors choose to diversify their portfolio by holding both growth and value stocks to balance potential risk and reward. Example of a growth stock. Prime example of a growth stock is Amazon. As of 2023, Amazon is one of the largest companies globally and has long been considered a growth stock. Despite its size, Amazon stock has maintained a high price-earnings ratio, reflecting investors' expectation of continued rapid growth. Even as the company grows, Amazon's projected earnings for the upcoming year remain high, contributing to the belief that its stock price will continue to rise. However, like all growth stocks, Amazon's value could decline if growth expectations are not met. Are growth stocks risky? Investing in growth stocks carries significant risks. While these stocks offer the potential for high returns, the trade-off is that they come with considerable uncertainty. A company's future performance may not live up to its investor expectation, resulting in a sharp decline in stock prices. The inherent risk in growth stocks lies in the possibility that the company's anticipated growth fails to materialize, leaving investors with a loss. Growth stock example. Imagine a biotech startup company on a promising new cancer treatment. At the outset, the company might be in the early stages of clinical trials with no guarantees that the product will make it to the market. If the drug succeeds and gains FDA approval, the company could experience tremendous growth, increasing its stock price. However, if the drug fails, the company's potential may never be realized and investors could lose money. How to distinguish between growth and value stocks? To differentiate between growth and value stocks, investors look at different financial metrics. Growth stocks typically have higher price-earnings ratios and low or non-existent dividends, reflecting their potential for future capital appreciation. In contrast, value stocks have lower price-earnings ratio and often pay dividends, which signals strong company fundamentals and a more stable value. Conclusion: growth stocks offer significant upside potential for investors who are looking for higher returns through capital gains. However, this potential comes with increased risks, as the expected growth may not occur. Unlike value stocks, which are more likely to provide steady income through dividends, growth stocks rely on the success of the company's expansion strategies to drive share price appreciation. Investors must weigh the risk and rewards carefully when deciding whether to invest in growth stocks. If you have any questions or uncertainty about growth stocks versus value stocks, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.